Hi, I'm Peter Rose, founder of Longwood Currency Trading. Why do I only trade the currency market? I've done some videos before on why I only trade one currency pair, but not so much on the currency market itself. I've made mention many times of my website, longwoodcurrencytrading.com. On the currency trading page, that there's 7 reasons that I list why I think that currency markets are far superior to any other investment vehicle that we have available to us. Stocks, bonds, commodities, old tires, real estate, whatever. So I'd like to go over those 7 briefly. And then if you go to the website and read them, if you have any questions, throw me an email. I'd be happy to chat with you. But the number one reason is because it's open 24/5. You don't find any other market that's like that. So from Sunday, and I'm East Coast U.S. time, Sunday 5 p.m. it's open, and it closes the following Friday at 5 p.m. The rest of the markets are regular business hours. Might be 7:30 in the morning to 3 o'clock or 4 o'clock in the afternoon as regular business hours. I don't know what time zone you're in, but if I'm in East Coast U.S. time and it's 8 o'clock at night, I can't trade any other market. They're all closed. Commodities, futures, stocks, bonds, everything. Closed. Everybody's asleep, but not the currency market. Number 2 out of 7 reasons is that the price action of the currency market is based on the economies of the 2 countries in the pair. That's like a large ocean liner. The captain turns the wheel, and the ship, you can see it start to arc off here to the right, and if you're in a boat, he's going to the right. I'd stay out of his way, because it's very difficult. Even if you threw that wheel over hard, it just would take a long time to get back. So for determining the direction of the market, it's not based on a gazillion different things that could alter that. Well, I mean, it is, but interest rate theory is the big dog in the whole thing. And so if you see that the market is proceeding in a certain direction, and the particular federal bank that you're dealing with isn't messing with the interest rates every 2 weeks, then the direction is pretty well set. Or even like in the U.S. today, this is 2023, the end of June 2023, the Fed has raised interest rates now 13 times. And so what's it going to do today? I mean, that greatly affects the perception of the economy and the value of the dollar on almost a weekly basis, because you just don't know what they're going to do. But eventually they'll come to an interest rate and they'll say, okay, that's it, and then they'll start reducing it. Once they start reducing it, it won't start coming back up. It's going to be like that big ship. That's the theory behind price action based on whole economies, as opposed to a single stock. You trade Bob's real estate brokerage and garbage collection service stock, and Bob could be a convicted felon. He could be cheating the company. The customers could all come down with cancer spores or something from dealing with him. You don't know. There's so many variables that immediately and directly affect the price of that stock, whereas that's not the case in a currency in a country. The president of the country could be found to be corrupt, and it will cause some minor maybe disruptions in the price, but that doesn't change the economy of the country. And if the removal of the president will ultimately change the economy of the country, it's going to take time. So that's price action based on whole economies. The third reason out of 7 is that it's rare to find gaps in the pricing. And that's because of the liquidity. When you have high liquidity, you don't get gaps because you get your orders filled, no matter where they are, or how stupid they are. Well, you know, that's if you're trading the major pairs and you're trading in hours time. But I mean, if I'm in the United States and I'm trading euro dollar, the dollar and the euro, and nobody's open at 2 o'clock or let's say 1 o'clock in the morning. Euro won't open until London Open is 2:30 a.m. Eastern U.S. time, 3 o'clock. So 1 o'clock, 12 o'clock, 10 o'clock at night, 8 o'clock at night, it's not open. Neither country is open. So you're going to get spikes, you're going to get high spreads, you're going to get high volatility. And that's up to you if you're going to trade there. And if you happen to be trading carry trades and you're carrying these over from day to day, you're going to get caught in that stuff. And I've seen, I've seen spreads of in the pound dollar, for example, which is usually spreads usually a pip and a half. I've seen it go to 15 pips in off hours. 15 pips. So you got a trailing stop at 10 pips or 15 pips, and they see a whole bunch of people that are trailing the stop, and they get taken out. And we're, oh, what happened? You know, you got to take your stops off if you're going to trade like that, or you got to give them room to breathe. Oh, okay. What are you going to give? 50, 60 pip stop? I've seen after hours trading, even in hours trading, 15 minutes a chart, 120 pip move. So are you going to find gaps? Well, yeah, if you happen to be on a 5-minute chart, then you're going to get a gap. Will it fill later? Yeah, it'll fill later, but it'll be too late for you. But if you're trading reasonably, the likelihood of finding those gaps or seeing those gaps or having them happen is very, very low because of the liquidity. Even late at night, because people are leaving limit orders and standing orders in their market. So you're going to be okay. Of course, there's a 0.5% chance that you won't be okay. Well, you know, you could get in your car and somebody blows a stop sign and rams into the side of you. How many times is that going to happen to you in your life? It happened to me once. I'm 74 years old, so one time in 74 years, and I drive the car, and I'm in the car 2 times a day going somewhere. So that's a lot of driving in the car. And same thing with finding gaps in the currency market. Don't get your bowels in an uproar. For all practical purpose, from a statistical probability standpoint, you don't have to worry about gaps. The fourth reason that I like the Forex market is because there are no lock limits like there are in commodities. And that means that if you're short and you're thinking the commodity is going to go down, and all of a sudden it jumps up, and it jumps up so far it hits the lock limit, it closes it out. So you don't have time to react. You're short, you're lock limit up. In other words, the markets aren't trading. It opens the next day. You get a lock limit move. The market doesn't open. You're 2 lock limits out and you're short. It goes to the 3rd day, and it's very likely that happens. I've seen that happen more often than you'd want to know. At 2 lock limits, you lose your house. At 3 lock limits, you might as well, jump. There's a lot of people that lose their money that way. If you're on the floor and you see that shit going on and you hear the commotion going on, you're out and you take a big, big hit. There's a lot of guys on the floor that used to go broke. You read the books about these traders, commodity traders. So fortunately for us, in the currency market, there is no lock limit. There's no limits. It's going to move because the liquidity is there to absorb it. That's why they don't have those rules. Stupid rules. The 5th out of 7 is there's no uptick rule. In the stock market, if you're short, or you want to go short, and the stock is going down like crazy, I want to go short, I want to go short. You can't go short until you get an uptick. I don't know why that's there. It's protect the poor stock trader. But if you're short, if you're trying to go short, you're not going to be able to go short until that price ticks up. So if you happen to be long and the price is going down, you're not going to be able to get out. You're not going to be able to sell. Number 5 out of 7. Oh, I'm sorry, that was 5. Number 6, I'm sorry. The currency market dwarfs all other markets. It's today in end of June 2023. It's something like $6.6 trillion, almost $7 trillion a day. If you took the Dow Jones and the S&P 500 or whatever, you might get a 28 billion or a $30 billion a day dollar volume transaction level. $30 billion in comparison to 6.7 trillion, it's just shit dust. It doesn't even matter. These are huge markets. Why not trade the biggest thing? If you were going to get a 5% commission selling washing machines as opposed to a 5% commission selling real estate, wouldn't you want to sell real estate? Why wouldn't you want to trade in the hugest market that's out there with number 7, the best leverage of any investment vehicle that you can find, so you can take advantage of the size of that market? So number 7 is the leverage. Yes, you can get stupid leverage and 100 to 1, 200 to 1. Most of the people that are doing this shit will trade at 200 to 1. You can even get some brokers that'll give you 500 to 1 leverage. You're stupid if you take it. I'm sorry, but that's just the fact of it. A survey done by a large FOREX broker many years ago said that 90% of the traders lost 90% of their money in 90 days. That's over 43 million transactions, 25,000 clients. 90%, 99 and 90. Why do you think that is? Well, most of them don't know what they're doing. But the other is they're trading with large leverage and they don't know what they're doing. Or they're trading with large leverage and they do know what they're doing. It doesn't matter, because if you're trading with that kind of leverage, that's pissy risk management. I mean, in real estate, if I want to buy real estate, I want to buy investment real estate, it's 30% down, no tears. It doesn't matter what the residential market is doing. You might be able to get 5% money in the residential market. Who do you think all the people are that go broke when we have a downturn? It's the guys that are over leveraged, the guys that took their 5% money, they got big mortgages, they lose their job for 15 minutes and they're gone. So to be safe in real estate, that's why you put 20% down, because real estate might, in a correction, drop 10%, 15%. That's a huge drop for real estate, considering that real estate over the long run, a 20-year period, is going to appreciate at about 8%. So if real estate in 1 year drops 12 or 15%, that's a lot. I was in real estate for 40 years. I had bought a condo and moved in there, and at one point it was worth $250,000. We had an economic collapse, and the condo, and I was thinking about retiring in a couple of years and moving, and so I thought, well, what's the value right now? I think it's probably worth, it was worth about $250,000 before all the crap started. I said, I wonder what this is worth if I had to sell it today. Give me a better gauge on how long I should plan on waiting to get it back to where it needed to be. Had an appraisal done, $150,000. From $250,000 to $150,000. That's a $100,000 loss. I've lost $1 million twice in my life due to economic collapse. I've made that back each time, but it took me 10 years each time. And so I never lost any. I lost net worth. I didn't lose my assets because I was never leveraged more than 39%. That was my leverage on my properties. So because I held them for long periods of time, they could lose 50% of their value, but it never hit my mortgage amount. So that the bank was calling my mortgage. It never went below the you needed 10% or 20% equity above the mortgage level. It never hit that. I lost net worth, but I didn't lose the assets. That's why I was able to come back each time, because I played the long game and I understood the leverage. Don't listen to these guys that are, man, most of the guys that are out there that are trying to teach you how to trade took a $10,000 or $20,000 account. After they lost about 9 times in a row, they finally put some pieces together. And then at 200 to 1, they're out there with a $10,000 account or $20,000 account. You know, a $20,000 account at 200 to 1 leverage, you can buy 40 full lots. But you buy more than that. You probably buy 50. In any event. You get lucky 6 times with a $20,000 account, 7 times, you're going to 6-figure account. Roll the dice again. Boom, now you got $1 million account. And that's where all these silly, oh, don't risk more than 2% of your account, don't risk more than 1/4% of your account, because the guys don't know how to trade. They can make 1/4% on their money and make $5,000 a day. Now you do the math on that. $5,000 a day times 4 days a week, so they get a day off. It's a lot of money. How much money do you need? If you trade $1 million account, now you're trading $1,000 a pip, right? $2,000 a pip. I mean, the money you can make is phenomenal. But when you leverage it, the statistics are not 90% at 200 to 1. You're going to lose 98% of the time at 200 to 1. Just don't do it. In the United States, they will let you go as much as 50 to 1, which is 2%. They would prefer that we trade at 20 to 1. It doesn't make any difference. 2%, 5%, it doesn't make any difference. It's better than anything else you're going to get anywhere. Even in the stock market, you need 50% to if you're a patent day trader, you're going to trade more than 6 times a week, you need $25,000 in your account to trade. If you're trading more than 6 times a week. And if you're an investor and you want to buy stock, the best leverage you're going to get is 50% margin. 50%. Geez, real estate better than that. You want to buy a residential house, you get 5%. You'll get wiped out eventually, but that's neither here nor there. So in the currency market, yeah, you can get 200 to 1, but don't take it. Use good risk management guidelines, and if you don't have somebody around to tell you what that stuff is, you better find somebody, because otherwise you're going to be a 90-90-90 winner. And so you just don't get involved in that. Those are my 7 reasons for why I trade the currency markets. You may disagree with them. I've been studying these markets since 2007, and I've been studying, the currency markets since 2007. It's 2023 now. And I've been involved in studying the financial markets themselves since the mid-1970s. That's mid-1970s. And so I've seen a lot of stuff, and that's my experience. Why did I fail? When I started out trading, I didn't open an account until 2012, a live account, because I was doing it as an academic. I was doing real estate at the time, so I didn't need to trade, didn't want to trade, didn't want to distract myself. I just loved to study it. In 2012, I opened a couple of mini accounts, lost those. Let's go back and do more study. So I'm studying from 2007 until about 2018, 2019, something like that, studying like a champ. So I figured I had it all down. I was making 15% a month on month, in my demo account. So I put $45,000 into my account, rock and roll, because that's what I had been doing all my computer simulation work against and all that other kind of stuff. And I lost $40,000 very quickly. And I wasn't at 200 to 1 leverage. I was at reasonable leverage. If I would have been at 200 to 1, I would have lost it faster. I'd have still lost it, but I lost it faster. So it didn't take more than about 6 months to drop that $40,000. And I stepped back and I go, what happened here? Other than I understood there are some emotional issues that I hadn't realized were going to take place, the difference between a demo and a real account. I can deal with that. I've been in martial arts for 50 years. Should have figured that out ahead of time. I didn't. But in retrospect, I was able to do that. I stepped back from the market, I looked at it, I said, what's the market consist of? What's really driving this thing? How would I break this up like I would as a software engineer? I spent 33 years as a software engineer. How would I break this problem, this currency market trading problem, down into reasonable phases so I can see what's going on? Where are the hiccups? Where are the problems? And that's where what I've called, if you've watched my videos, the life cycle of a currency position. Entry analysis, position management, exit methodology. What are the problems in each one of those phases? How can I develop a bunch of rules for that? I figured all that out in 15 minutes. Didn't take me any time because I had the knowledge background in order to do that. Why didn't I do that in the beginning? Because I trusted these fools that had been trading at 201, got lucky. When I was learning real estate, if I go out and talk to an investor, I'd say, hey, I bought this building and I got blah, 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 blah. What do you think I ought to do? And the person would say, well, I ran into that, and boom, and you ought to try to do this. And it worked. It was a straight scoop. These people don't know the answers in the currency market. They don't know the answers to solve the problems that you have. They'll tell you to use a Fibonacci number, or you don't understand engulfing candle patterns, or whatever other crap they're going to come up with. I stepped back from it. I eliminated all the clutter. The rules popped out at me. I took that remaining $5,000 that I had and I doubled that in about 4.5 months. I was a couple $100 shy, as I've said many times. I just added another $10,000 to the account and I went on from there. Did I lose money after that? Sure, I lost money after that. I made money and I lost money, and I was improving things and improving those rules. But the basis, the foundation, entry analysis, position management, exit methodology, that held true. And the three primary rules that I came up with stand today. They've been improved on, but it's so simple. Because I'm a software engineer. You take complex problems, you break them down into pieces, and you solve the pieces, and then you hook the pieces together. That's what I'm trained to do. And once you learn that's the tough part about trading, is learning how to do that. The unfortunate thing is nobody knows how to teach that because nobody has my background. But they can kind of approximate it. I've seen some people out there that know what they're doing and can kind of express it. Just because somebody made, $2 million trading or $500,000 trading doesn't mean they know how to teach it. So as I began to trade, after that debacle and the solution and doubling that $5,000, I really had to change the way that I was studying that market to eliminate so much of the useless information that was out there, stuff I didn't need to know. 99% of what you folks are looking at and studying, you don't need to know in order to trade. You'll learn that stuff as you develop your trading skill. You'll go, oh, I lost money. Why did I do that? Then you'll have a reason for learning that particular information. You'll go out, you'll research it. Oh, that's probably what happened. And you'll get better. But if you try to learn that stuff all up front before you start trading, that's like trying to learn a foreign language from the dictionary. You're not going to be able to do that. It's just information. You have to, number one, what's the relevant information? Out of the 30 gazillion things out there, what are the 6 or 8 or 9 or 10 critical nodes of information that you need to know? That's all you need to know. And then you whittle those down so that you take the stuff that's similar and combine it together and then develop a rule to solve that problem. It's that simple. Well, getting to that point is not that simple. It's very difficult to get to that point if you're trying to do it on your own and you don't have the background in order to understand what that process is. It's like you might be able to drive a car, but you're not going to be able to get into a semi and drive that. You'll rip up the gears or, whatever. That's why people pay $6,000, $8,000 to get a CDL license. Because you have to learn how to drive to big rigs. You want to trade the currency market, trade the largest market in the world. You better understand what the rules are. You better understand what's going on. You're not going to get it out of a book, and you're not going to get it out of some fool because his experience is based on success at 200 to 1. And you're not going to get it from somebody that doesn't know how to teach what they do. If they're up there showing you Fibonacci stuff and engulfing candle patterns and Elliott wave theory and all this kind of stuff, bat fucking patterns, I can't even believe it. I've got a degree in physics, almost a minor in math. Don't try to fade me with that ridiculous information. You can't support it. You can't do it. And but many of the folks that are out there refuse to believe that. And yet a lot of them are the same folks that are writing me emails and saying, oh, I got this problem, I'm trying to do this. I go, well, do this instead. And they argue with me. Okay, that's fine. Oh, gee. Go to my website, longwoodcurrencytrading.com. Go to the currency trading page and take a look at those 7 characteristics of the currency market that I identify as why I think the currency markets are the strongest. See what you think. If you've got any questions, throw me an email. Be glad to communicate with you. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.